Welcome back to the deep dive. Today is February 6th, 2026. If you have been watching the markets lately, specifically the energy sector, well, you know the ticker we have to talk about, VST, Vistra Corp.
Oh, absolutely.
Yeah.
The stock that everyone wishes they had bought 5 years ago.
Yep.
It's been the talk of the town, to put it mildly.
Seriously, I mean, if you pull up a 5-year chart, it doesn't even look like a utility stock. It looks like a tech rocket ship. It's up something like what, 600%?
At least. But that's the interesting part, right? That's the past. Recently, it has, hit a bit of a wall. It's been chopping around.
Exactly. We're seeing it trade in this, say, 140, 153 range, pulling back pretty significantly from the absolute highs.
Which naturally has people asking the big questions. Was that the top? Did we miss the boat entirely? Or is this just a pit stop consolidation phase before it becomes a massive long-term compounder?
That is precisely why we're here today. We are stepping into the war room. We are putting on our hats as senior portfolio managers at a long-term value fund. Think of yourself in that seat right now.
Right. Our job isn't to guess next week's price.
Not at all. We are not day trading this. We are not looking for a quick flip. We are looking at a 3 to 5 year hold. We need to decide if this company is a true compounder, a business worth parking serious capital in for the rest of the decade.
And to do that, you have to look past the headlines, past the stock chart. We have a massive stack of research here on the table. We've got S&P credit upgrades, the fine print on the Cogentrix and Energy Harbor acquisitions, the Q3 2025 earnings, which were messy, to say the least.
Messy is a good word for it.
And of course, the big one, the massive Meta partnership that was announced just last month.
The Meta deal is the shiny object everyone wants to talk about, and we will get there. But I want to start with the identity crisis, because I think that's the core of the whole thing.
What do you mean by identity crisis?
Well, if I just Google Vistra, I see a utility company. I see pictures of power plants in Texas. I see coal stacks. I see natural gas turbines. But then I read the analyst reports, and they're calling it an AI infrastructure proxy.
That's the tension. That is the entire investment thesis in a nutshell. Is it a boring old world utility, or is it the engine room of the entire digital economy? The market can't seem to decide.
So let's strip it all down. Let's do our job as analysts. Before we even get to the AI hype, what is the actual machine here? How does Vistra actually make its money day in and day out?
To really understand Vistra and why it's survived and thrived, you have to understand the integrated model. This is their moat. It is their first line of defense against the chaos of the energy markets.
Okay, integrated is one of those corporate buzzwords that can mean anything. Break it down.
Right. It sounds like jargon, but in this case, it means something very specific and very powerful. Vistra plays both sides of the electricity market. On one side, they are the largest competitive power generator in the U.S. The biggest. We're talking about a capacity somewhere between 41 and 50 gigawatts, depending on how you count the latest acquisitions. That's the generation side of the house. They literally make the electrons.
Okay. So that's the factory. They own the power plants.
Exactly.
Yeah.
But on the other side, they are a massive retailer. They own brands you've probably heard of, like TXU Energy, Ambit, and a bunch of others. They serve 5 million customers across 20 states.
5 million. That's a huge footprint.
It's enormous. And in Texas, which is their crown jewel under the ERCOT grid, they supply electricity to nearly a third of all residential and commercial customers.
So they make the power, and then they turn around and sell that same power directly to the consumer. Why does owning both sides of that transaction actually matter? Why not just be really good at one or the other?
Because of volatility. It all comes down to managing risk. Think about the Texas grid, ERCOT. It's basically the Wild West of electricity markets. It's isolated, it's deregulated, and prices can fluctuate wildly based on the weather. A heat wave, a winter storm.
Right.
Now, imagine for a second you're a pure retailer. All you do is sell power to Grandma Smith at a fixed rate, say 12 cents a kilowatt hour. Suddenly, a massive heat wave hits. Everyone cranks up their AC. Wholesale power prices on the grid spike to $9.
So you're contractually obligated to sell at 12 cents, but you have to go out and buy that power for $9.
You're bankrupt in a week. And that's not theoretical. That happened to a lot of smaller retailers during the big winter storms a few years back. They got wiped out.
Okay, I see the risk. So how does Vistra avoid that?
Because while their retail arm, TXU, was technically losing money on paper buying that hyper-expensive power, their generation arm, the power plants, was the one selling that power onto the grid at $9 a kilowatt.
So the money just moves from the left pocket to the right pocket.
Precisely. It's a natural hedge. When wholesale prices are sky high, the generation business prints cash. When wholesale prices are really low, the retail business sees its margins expand because its input costs just plummeted. It smooths out the earnings and cash flow in what is fundamentally a very violent and unpredictable industry.
That makes a lot of sense. It's a kind of internal insurance policy. But I've noticed they've recently formalized this structure into two distinct segments, right? Vistra Vision and Vistra Tradition.
It did, yeah. And you might think it's just marketing fluff, but it's actually a crucial way for us as investors to understand the valuation and the future of the company.
How so?
Vistra Vision is the growth engine. That's where they've parked all the assets the market loves right now. That's the nuclear fleet, the solar farms, the battery storage projects, and that massive, stable retail arm. That is the clean, forward-looking, customer-facing business that, in theory, should get a high multiple from Wall Street.
And Vistra Tradition is everything else.
Tradition is the workhorse. It's the legacy fleet. The natural gas plants and the coal plants. It's dirty, it's old economy, it's not sexy at all. But here's the key. It is absolutely critical for grid reliability. And more importantly for us as portfolio managers, it prints unbelievable amounts of cash.
So Tradition funds the growth of Vision.
That's the flywheel. The cash from the old world is building the bridge to the new world all under one roof.
Okay, so we've established a durable business model, a real moat, but durability alone doesn't get you a 600% stock return. That comes from a massive growth story. And that brings us right to the AI power proxy narrative.
A hype train.
Right. We keep hearing that data centers and AI in particular are going to suck the grid dry. Is this real, or is this just a narrative to pump the stock higher?
It is absolutely real, and we have the receipts for it right here in the source material. The single biggest piece of evidence is what I'd call the scarcity premium.
Explain that.
You have to understand the physics of an AI data center. It's not like your old school server farm that just hosted websites.
How's it different?
Two things: density and uptime. These massive clusters for training models like Llama or GPT-5 or whatever comes next, they run 204/7 at incredibly high utilization rates. They cannot tolerate downtime. A minute of downtime could cost millions in a failed training run, and they consume just staggering amounts of power.
And at the same time, all the big tech companies, Meta, Microsoft, Amazon, they've all made these very public net zero carbon commitments.
Exactly. So they have this impossible problem. They need huge amounts of power. It has to be on all the time, 24/7, and it has to be carbon-free.
So they need green power.
Right. But there's a problem with that. Wind and solar are great, but they're intermittent. The sun, doesn't shine at night. The wind doesn't always blow. You cannot run a billion-dollar AI cluster on maybe. You need baseload power. Clean baseload power.
Which really only leaves one option on the table.
Nuclear.
It's the only carbon-free energy source that runs 24/7, 365, rain or shine.
It is. But here's the real problem, the bottleneck. You can't just go out and build a new nuclear plant. It takes a decade, maybe more. It involves massive regulatory hurdles, public opposition, and it costs tens of billions of dollars. Nobody is building them at scale in the U.S.
So the existing operating nuclear plants are like beachfront property in Manhattan. They aren't making any more of it.
They are the single scarcest asset in the entire energy world right now. And Vistra, thanks to that incredibly shrewd acquisition of Energy Harbor back in 2024, now holds the second largest competitive nuclear fleet in the entire country.
And that, I assume, is what the Meta deal was all about. That's the proof in the pudding.
That was the tipping point, the moment the thesis went from theory to reality, January 2026. Vistra signed a definitive 20-year agreement with Meta.
Let's pause on that. 20 years. In the tech world, 5 years is an eternity. 20 years is a geological epoch. Why on earth would a company like Meta sign a contract that long?
One word: desperation. And strategy. It's a massive tell. It validates that this power shortage is not a joke. Meta is effectively saying, we are so deeply worried about securing reliable, clean power for our long-term AI roadmap that we will lock in this specific nuclear capacity for 2 decades.
It completely changes the quality of Vistra's revenue, doesn't it?
Completely.
It's not just selling a commodity into the open, volatile spot market anymore.
Correct. It becomes contracted cash flow. You've got an investment-grade counterparty, one of the richest companies in the world, guaranteeing a revenue stream for 20 years. That is worth a much, much higher multiple to an investor than just selling electricity on the spot market day to day. It de-risks the business model significantly.
Now, when I look at the competitive landscape, there's one name that always comes up alongside Vistra, and that's Constellation Energy, ticker C.
The darling of the nuclear trade. The pure play.
Right. Constellation is almost entirely nuclear. So if I'm a portfolio manager and I want to play this nuclear for AI theme, why wouldn't I just buy Constellation? Why bother with Vistra and all its legacy coal and gas plants?
That is the key debate raging in the market right now, and it's a great question. Constellation produces something like 90% carbon-free energy. They are the premium brand in the space, no question.
So what's Vistra's edge?
Vistra is catching up on the nuclear side,
Yeah.
but they have something Constellation doesn't, that tradition fleet, the gas and coal.
Which seems like a liability, not an asset.
5 years ago, I would have agreed with you. But in a world where the grid is becoming increasingly unstable because of too much intermittent renewable penetration, having dispatchable gas assets plants you can turn on with a switch when the wind stops blowing is actually becoming more valuable, not less.
So Vistra is a diversified play.
Exactly. Vistra offers you the nuclear upside, but with the reliability backstop of natural gas. Plus, they have that massive retail arm in Texas, which is a steady cash flow generator that Constellation just doesn't have.
And they're just bigger.
They're winning the scale war. And if you look at the operating metrics, Vistra's is just running a tighter ship than some of its peers. You look at their net margin, it's around 6.7% versus a competitor like NRG Energy, which is down at 4.8%. It might not sound like a lot, but on billions of dollars of revenue, that's real money.
Okay, speaking of running a tight ship, let's open up the books. We have to talk about the financials. Because if I'm a shallow observer, if I'm just glancing at the headlines for that Q3 2025 earnings report, I'm seeing a lot of red flags.
You're seeing the mix.
A big-time miss. Revenue was, what, $4.97 billion, which missed analyst estimates. And according to some of the metrics we have, it was down nearly 21% year over year. Net income fell. I mean, if this is such a great AI growth story, why is the top line shrinking?
This is exactly where we earn our fees as sophisticated investors. This is where you separate from the noise. You have to look past that headline number because it's incredibly distorted.
Okay, so what's distorting it?
There are two main things going on. The first is pretty simple, fuel prices.
Natural gas prices dropped a lot in 2025.
Significantly. And because of how utility accounting works, with pass-through mechanisms, when fuel costs drop, reported revenue also drops. But the actual profit margin might stay exactly the same or even improve. So in this industry, revenue is often a vanity metric. It's not the real story.
Okay, that explains some of it. What was the second factor?
The big one. Unrealized mark-to-market losses on derivatives.
All right, you've got to translate that from accountant speak into plain English for us.
Vistra is a very sophisticated hedger. They don't want to be exposed to wild swings in power prices, so they sell power forward years in advance to lock in prices.
Makes sense.
But JAP accounting rules say that every single quarter, they have to mark the value of those contracts to the current market price. So if they hedged at, say, $50, and the current market price for power in the future drops to $40, they have to book a temporary unrealized loss on their income statement for that quarter.
But it's a paper loss. They haven't actually lost any cash.
Not a single dollar. They'll just settle the contract later at the agreed-upon price. But it creates this massive volatility in the net income line that has absolutely nothing to do with the actual cash entering the company's bank account.
So the business isn't broken, the accounting is just weird.
The accounting is weird and misleading. If you want to find the truth, the real signal of the company's health, you have to look at EBITDA, earnings before interest, taxes, depreciation, and amortization.
It's a better proxy for cash flow. And what does the EBITDA story say?
It says the business is absolutely exploding upwards. Just look at the guidance they've given. For the full year 2025, they guided to an adjusted EBITDA of about $5.7 billion to $5.9 billion.
Okay, solid number.
Now look at 2026.
Yeah.
For the year we're in now, they initiated guidance at $6.8 billion to $7.6 billion.
Whoa, hang on. That's almost a $2 billion jump in profitability in a single year on an already huge base.
It's a step change. It's a fundamental re-rating of the company's earning power.
Where is that coming from? I mean, you can't just cut costs to get that kind of jump. That has to be new high-margin revenue.
It is, and it's primarily coming from one place, the PJM capacity auction results.
PJM, that's
Yeah.
the big grid operator covering the Mid-Atlantic and the Midwest, right? Pennsylvania, Jersey, Maryland.
That's the one. And we need to explain this because it is the single biggest driver of their cash flow right now. PJM runs a special auction where they basically pay power plants just to promise to be available 3 years from now. It's like a retainer fee to ensure the lights stay on.
Okay, so they get paid just to exist, essentially.
Essentially. And for years and years, that clearing price was really low, $30, $50 per megawatt day. But in the most recent auction, the one for the 2025-2026 delivery year, the clearing price skyrocketed to $329.17.
Wait, from 50 to over 300? That's not a jump, that's a different planet.
It's nearly a 10x increase. It's a historic price. And because Vistra has a massive generation fleet in the PJM market, including all the key assets they bought from Energy Harbor, they are effectively getting a massive, massive pay raise just for showing up. That money flows almost directly to the bottom line.
So its supply crunch isn't some theoretical thing analysts talk about. The market is literally paying 10 times more just to ensure reliability.
The market is screaming that there is a shortage of reliable power. And Vistra is one of the biggest beneficiaries of that scream.
But as a value investor, I always have to ask the next question. Does this massive EBITDA number actually turn into real cash that the company can use? Or is it all getting eaten up by capex and maintenance just to keep the lights on?
That's the cash conversion part of the story, and it's just as impressive. Vistra has a specific target to convert more than 60% of that adjusted EBITDA into what they call free cash flow before growth, or FCFBG.
60% conversion is extremely high for a heavy industrial company like this.
It is. It's because their fleet is largely already built and paid for. They aren't building a new nuclear plant from scratch for $20 billion. They're just maintaining and upgrading what they already have. So for 2026, they are projecting roughly $3.9 billion to $4.7 billion in free cash flow.
$4.5 billion in cash. That is some serious firepower.
And here's the best part. It's protected. We can call it the hedge fortress. As of their last report in late 2025, they had already hedged 96% of their expected 2026 generation volumes.
96%. So you're telling me that even if power prices completely crash tomorrow, their entire 2026 profit year is already made?
Essentially, yes. They are not gambling on the weather or the spot market. They have locked in their profits for this year. That gives them and us as investors incredible visibility and certainty.
And that's got to be why S&P finally upgraded them.
Absolutely. In December 2025, S&P upgraded Vistra to investment grade, a BBB rating. That's a major milestone. It lowers their cost of debt. It opens them up to a whole new class of bond investors.
Yeah.
It's a huge stamp of approval.
And what about the debt itself? The gross number is still pretty big.
It is. Gross debt is around $18 billion. That sounds high, but the leverage ratio, which is what really matters, is falling like a stone because the earnings are rising so fast. Management expects to be in the 2.6x to 2.8x debt to EBITDA range by the end of this year. That is very healthy and very manageable.
Okay, so let's recap. We have a durable moat from the integrated model. We have exploding high-quality cash flow. We have a solid investment-grade balance sheet. Now we get to the part that really matters for the stock price long-term, the jockey, the CEO, Jim Burke. How is he spending this $4+ billion of free cash flow?
This is where the thesis goes from just a good company to a potential shareholder wealth machine. Management have a very clear, very disciplined capital allocation flywheel, as they call it. They're not just sitting on the cash or wasting it.
I see the buybacks in our notes, and they seem aggressive.
Aggressive is an understatement. They have an active authorization to buy back $1 billion of stock a year, every year, through 2027. But look at the track record, not just the promise. Since November 2021, they have reduced the number of outstanding shares by approximately 30%.
Wait, say that again, 30% in just over 4 years.
30% of the company has been repurchased and retired. Think about the math on that. If you bought one share of Vistra in 2021 and you just sat on it and do nothing, your ownership stake in the underlying business has grown by 1/3.
Without you spending another dime.
Exactly. It's the ultimate cannibal strategy. It's what you read about in the classic books about the great outsider CEOs. Management looked at their stock, saw that it was fundamentally undervalued by the market, and they bought it backhand over fist.
It's a massive lever for concentrating the earnings per share. I mean, even if the company's total profit stayed flat, your earnings per share would go up 30%.
But the profit isn't flat. It's booming. So you get this incredible double compounder effect. The earnings pie is getting bigger, and your slice of that pie is also getting bigger at the same time.
But they're not just shrinking the company. They're buying growth, too. Let's talk about the acquisitions. Cogentrix, for example.
Right, that was just last month, January 2026. They bought Cogentrix from Carlyle for $4 billion.
Is that a good deal? $4 billion is a big check to write, even for a company gushing cash.
The math looks very solid. Based on our research, they paid about 7.25 times the expected 2027 EBITDA of those assets. In this market, buying a portfolio of high-quality modern gas assets for under 8x EBITDA is a steal.
Why is it a steal? What's the alternative?
The alternative is the build versus buy dynamic. If Vistra tried to build those same gas plants from scratch today with inflation and supply chain issues, it would probably cost them twice as much, and it would take 5 years of permitting hell to even get started. Instead, they bought them turnkey. They start generating cash for Vistra on day one.
And it's interesting, Cogentrix is natural gas. Lotus Infrastructure, another recent acquisition, was also gas assets. They seem to be doubling down on fossil fuels at the same time everyone else is talking about the green energy transition.
That is the Vistra Tradition strategy in action. It's a pragmatic, even contrarian bet. They are betting that while renewables will and should grow, the grid is going to need a lot of dispatchable natural gas to stay stable for the next 10, 20 years. They're betting that gas plants will become more valuable as reliability becomes more scarce.
It's smart contrarianism. What about growth capex on the vision side? Are they investing in the nuclear fleet?
Yes, and this is brilliant. They call them nuclear uprates. Instead of trying to build a new reactor, they're investing capital to put in better turbines, better digital controls, and other upgrades into their existing reactors to squeeze out more megawatts of power.
It's like putting a turbocharger on the car you already own instead of buying a new one.
It's a perfect analogy. And the returns are fantastic. They are targeting mid-teens levered returns on that capital. That is a phenomenal ROI. And a lot of that new uprated capacity is directly tied to supporting that 20-year deal with Meta.
Okay, one last piece on capital allocation. What about dividends? I know a lot of traditional utility investors love their quarterly dividend checks.
Vistra pays one. It's about $300 million a year in total, but the yield is tiny, something like 0.6%. It's clear where management's priority is.
On the buybacks.
Overwhelmingly. If you're an investor looking for steady income, go buy a different stock. Vistra is a total return story driven by share buybacks and long-term capital appreciation.
Got it. Okay, I have to admit, I'm feeling very bullish right now. The story sounds almost perfect, which means, as a portfolio manager, my job is to stop and check my blind spots. My job is to worry. What kills this thesis? What is the long-term bear case for the next 5 years?
The biggest, most unavoidable structural risk is what I call regulatory whiplash.
We are in 2026. The political environment is volatile, to say the least.
It's extremely. And the EPA is the ultimate wild card for a company like Vistra. Under the Biden administration, there were a series of very strict proposed rules on CO2 emissions, basically designed to force the retirement of coal and older gas plants.
Right.
Now, with the political shifts happening in 2026, the new Trump administration is publicly proposing to repeal many of those rules.
Which on the surface sounds good for Vistra, doesn't it? It lets them run their profitable tradition fleet for longer.
In the short term, yes. But the real risk is the uncertainty. These environmental regulations act like a pendulum. If Vistra makes billion-dollar investment decisions today, assuming a relaxed regulatory environment, what happens in 2029 or 2030 if the political pendulum swings back hard to strict enforcement? Those assets could become stranded.
You can't plan a 20-year asset life cycle when the fundamental rules of the game change every 4 years.
It's impossible. It makes long-term capital allocation incredibly difficult. And you have to remember, despite the nuclear growth, Vistra is still a heavy emitter. If a national carbon tax ever becomes a political reality in the U.S., they take a direct and significant hit to their bottom line.
Okay, that's a big one. What about operational risk? I mean, we keep saying they sell reliability, but these are giant, complex machines. Things break.
They do. And we have recent examples. We saw the fire at their Moss Landing battery storage facility in California.
Right. Battery fires are nasty. Hard to put out.
They're incredibly expensive, and they can take a huge amount of capacity offline for months, even years. And remember, the forced outage at the Martin Lake Power Plant that specifically hurt their Q3 2025 earnings.
Yeah.
The bear argument is that you are buying a collection of complex, aging physical machines that inevitably break. And if one of your major plants goes down during a super spike pricing event like a massive winter storm in Texas, your entire upside for the quarter, maybe the year, evaporates. You can't sell power, you can't generate.
It's not like a software company where you can just reboot the server. This is real physical execution risk.
Exactly. And then layered on top of that is the longer-term technology risk, the real existential threat.
You're talking about batteries.
I am. If battery storage technology has a major breakthrough, let's say solid-state batteries become cheap, durable, and massively scalable, then the entire economic model of Vistra's gas peaker plants is threatened.
Because you don't need them anymore. You can just store cheap solar energy from the daytime and use it at night.
And that would destroy the value of a huge chunk of the tradition segment. Now, it hasn't happened yet, and the timelines are uncertain. But over a 5-year investment horizon, it is a non-zero risk you have to consider. Vistra is hedging this by building their own batteries, but it fundamentally undermines their legacy moat in gas generation.
And finally, let's touch on interest rates. $18 billion in gross debt is a lot to service.
It is. They're deleveraging quickly, but if we stay in a higher for longer interest rate environment, refinancing that debt as it matures becomes more and more expensive. It's a slow bleed on the free cash flow that could otherwise be used for buybacks.
Okay, so we've weighed the good and the bad, the bull and the bear. Let's talk price. Let's talk valuation. Is this stock cheap at around $142 a share?
This brings us right back to that identity crisis we started with. The AI premium versus the utility discount debate. Right now, Vistra is trading at roughly 17.5x to 24x forward PE, depending on which analyst estimates you want to use.
For a traditional utility company, even 17x is on the high side. They usually trade closer to 15x.
That's true, but the key is to compare it to its closest peer in this new paradigm, Constellation Energy, CE.
And where does CE trade?
Constellation trades at over 30 times forward PE.
Wow. Okay, so why the huge valuation gap between the two?
Because the market, for now, views Constellation as a pure technology infrastructure play. It's 90% nuclear, it's clean, it's simple to understand. The market still looks at Vistra and sees a complicated company that's part nuclear, part retail, and part dirty utility because of the legacy coal and gas.
So the core of the valuation thesis is that this gap will close over time.
That's it, exactly. It's a multiple expansion story. The argument is that as Vistra fully integrates the Energy Harbor nuclear assets, as they execute on the Meta deal and sign more like it, the market will be forced to re-rate the stock and value it more like Constellation.
And if Vistra's multiple just goes from, say, 20x to 25x, that's a massive jump in the stock price, even without them earning a single extra dollar of profit.
That is the margin of safety in this investment.
Yeah.
You are buying a company that is growing its underlying EBITDA at 20+% a year, but you're paying a significant valuation discount relative to its closest peer.
The analyst consensus price target we're looking at is around $234 per share. From today's price, that implies something like 60% upside.
And many would argue that's just the base case. If the AI power demand story turns out to be even crazier than people predict, the scarcity value of Vistra's reliable dispatchable assets could drive it much, much higher.
But I have to admit, buying a stock that's already up 600% in 5 years is psychologically difficult. It feels like you've missed the easy money.
It does. But this is where you look at something like the PEG ratio, the price to earnings growth. Because their earnings are growing so incredibly fast, that massive jump from $5.7 billion to a midpoint of $7.2 billion in EBITDA, the E is catching up to the P very quickly. You aren't paying for yesterday's hype. You are paying for confirmed, guided to cash flow growth that is happening right now.
All right, it's decision time. It's time for the final verdict. We are the portfolio managers. We have to make a call. Conviction level for a 5-year hold, high, medium, or low?
For me, looking at all this data, the conviction level is HEH.
High. You're not hedged at all, even with the regulatory risks we just talked about.
Even with those risks. And here's the rationale. We are witnessing a fundamental structural shift in power demand in this country. The combination of data center growth, electrification of transport, and onshoring of manufacturing is creating a tailwind for electricity demand that we just haven't seen in decades. Vistra is uniquely positioned right at the intersection of being a cash flow conversion machine and meeting that AI demand.
Okay, summarize the bull case for me in one single sentence. The main reason to own this stock.
Vistra owns the scarce, reliable, 247 power that big tech desperately needs to win the AI race, and they are using the gusher of cash from that scarcity to aggressively buy back their own undervalued stock.
That's a powerful combination. Scarcity plus a shrinking share count. It's a classic recipe. Now give me the bear case summary, one sentence.
The primary risk is operational and regulatory execution. At the end of the day, it's a complex physical machine that can break, and it operates in a world where politicians can change the rules of the game overnight.
But on balance, we think the reward outweighs that risk.
I do. The Meta deal was the proof of concept. It proved this thesis is real. Vistra isn't just selling electrons into a commodity market anymore. They are selling certainty and reliability to the wealthiest, most powerful companies on the planet.
Well, there you have it. Vistra Corp. This is not your grandfather's utility company. Based on this deep dive, We are buyers at these levels for a long-term hold.
We are buyers.
Before we sign off, I have one final provocative thought for you, for our listeners to chew on. We talked about Meta signing that incredible 20-year deal. We talked about the absolute scarcity of clean, reliable power.
Right.
If power is truly the ultimate bottleneck for the future of artificial intelligence, are we moving toward a future where the big tech companies stop just signing contracts and they start buying these utility companies outright?
You mean like Amazon buying Vistra or Microsoft buying Constellation?
Why not? If you are Microsoft and you have $80 billion in cash sitting on your balance sheet, and the single biggest thing stopping you from winning the AI war is securing enough power for the next 20 years, buying a company like Vistra for $50 or $60 billion solves your problem permanently overnight.
That's a fascinating thought. The regulatory hurdles would be insane. I mean, the government would probably hate the idea of a tech company owning critical grid infrastructure, but the strategic logic is powerful. If power becomes the ultimate constraint, vertical integration might eventually go to the most extreme conclusion.
Something to mull over. Is Vistra the ultimate takeover target? We'll leave it there.